Well, good afternoon, everyone. Reality Bites. I wanted to have a 3/4 of an hour anyway to spend time with people that have a number of questions, and especially those that have been looking at the headlines and getting a little bit upset about and not too sure with what's happening out in the market. Now, I happen to know that the press can get it wrong, and I happen to know that also with headlines that they can be quite sensational and not really understand or give the understanding what is behind the headlines. So grab a sandwich, a glass of wine, whatever you've got to hand, and let's spend the next 3/4 of an hour together. I'm Nikki Connors, as you may know, and with me this afternoon is Austen Clarke. Hi, Austen.
Yeah, hi, Nikki.
Austen's has the Clarke Group, hundreds of millions of dollars worth of building in Auckland and in Hamilton over many years. You guys have got a great reputation, good family reputation, and also one of the things that Austen is specifically good at is a form of investment housing, which we're going to talk about as well in just a moment. But looking at the headlines this morning and what is one of the major topics, and of course it's all about the fact that the property market is tanking. The headline that I got this morning was rising rates, falling prices, orderly correction, but it feels like it's anything but. So that's the headlines that we're seeing. Now, if we look behind the headlines, and this is one of the things I think property investors that have experience, they understand that this is a long-term investment. And I know that I've said this before, but everything goes in cycles, especially in the property realm, for instance. For the last 40 years, we've had 21% interest rates. We've had the stock market crash. We've had SARS. We've had, and of course, we've had COVID. The property market has bounced back quite quickly. Now, if you look at the 80s, some of you won't remember, I do, even though I fudge my age, but I do remember the 80s. Interest rates were in 20%, 21% at the time. Now, inflation was at 20%. So when we're looking at inflation today, and we're looking at the interest rates today, we've got to put it in perspective of what the history has shown us over this time. Now, I know that I'm always so positive about property investment, and I've been called the Pollyanna of property investment before. But there are some key indicators around why I believe that we're going to see, first of all, interest rates that will come down, and also why property prices can't reduce. I mean, we've seen a little bit of a dip, maybe 1% per month and whatever. But remember, over the last few years, we've seen a 30% increase in property prices. Now, And of course, you'll know this, and part of that is to do with the build and council costs, and I mean it's just the inflation of building.
Of course.
Yeah. So we've seen a 30%, but if we look over the last 40 years, we're saying that property has doubled every 10 years. That's about a 7% growth rate. Now that's through all of these times where we've had the 21% interest rates, where we've had inflation at 20%. And of course, it was doom and gloom when we were in lockdown. And I think that I really believed and came out and put my head above the parapet there and said that was property prices weren't going to go down. But let's look at some of the key drivers that I believe indicate that we're going to see the continuation of that pattern of growth. Now, first of all, look at the employment market. I know I talk to other business owners, and I'm sure you find that in the building industry as well. Such a shortage of hands on the people on the ground.
Yeah, 100%, Nikki. I mean, I think the labour market at the moment is very strong here in New Zealand, and obviously, I think that's going to be its way, for the foreseeable future.
No, I totally agree. And what that means is that when you're looking at buying a mortgage, buying a house, or getting a mortgage, even though we're seeing interest rates that are higher than they have been over the last few years, but remember, over the last few years, this is the lowest it has been as well. What we've got at the moment is people feeling very confident with their jobs. If they leave a job, they know that they can get employment somewhere else. So when it comes to paying their mortgage, they know that they can service that mortgage. And we're seeing that as we are looking at first home buyers. We're starting to see that growth. We're starting to see with auctions that it's beginning to be quite robust. And I think that's one of the reasons as well. Now, here's another one. The financial markets, they're looking at 2 rate cuts in the US over the next year and a half by the end of 2023. So what does that mean for us? Well, we tend to follow what the US markets do. So, or US market does. So our rates and our fixed rates are influenced by the US market. And that's something, once again, it's a pattern and it's something that has continued to happen. The other thing is, once again, the doom and gloom of it all is that property prices are going to tank. Now, we haven't seen that. We've seen it leveling off, but certainly haven't seen that it's gone to the level that has been predicted. And I know that with some of your developments, you haven't decreased the prices because you can't.
That's right. Yeah, if you decrease the prices any more, then there'd be no margin. So I think that the market has slowed down, and maybe prices have maybe come back slightly, but I don't see that the market will that prices will come back much more. And I think that it's a short period, and I think in the next couple of years we'll see the market continue to increase.
And I totally agree with that. And I think too that although we may not get that 40% growth, I never predict that. I never put that into my assumptions anyway. I like to look at what history has shown us. And so, yes, we've got inflation, not as bad as the UK, for instance. But what happens? Of course, we're going to see interest rates go up because that's the way that the government and the Reserve Bank, that they tackle inflation. Now, when that gets under control, we're going to see those interest rates go down again. And as I said, it comes down to looking at what history has shown us in the past. The other thing, of course, is that, as we said, property goes in cycles. Now, it just so happens that there's been a few things happen at the moment, which is the interest rates, what's happening in the world, the Ukraine, all of those sort of outside influences, as we have seen that adjustment in the property market. But here is something that I am so adamant about, and I'm almost, I have to talk harshly to a lot of New Zealanders that come and speak to us, because if we're looking at having your mortgage paid off in the next 10 to 12 years, for instance, if we're wanting to give you and help you get a passive income, for most New Zealanders who don't have money in the bank, and most don't because they're so busy paying off their home mortgage and bringing up children, they don't have the cash to put into a bank account at 2%. They don't have the funds to put into stocks and shares. And although those are very good options and it should be part of any investment strategy, the trouble is it's a catch-22. You need money in those vehicles to make money. And so for most New Zealanders, the only form of currency that you have is equity in your home. So we do an exercise with our clients where we look at what they're paying at the moment, what their home mortgage is and what they're paying at the moment. And from that, we can see how many years it's going to take to pay off that mortgage. But just as importantly, and really frightening, it is very frightening, is how much interest you're paying to the banks over that time. So if we come back to the fact that you've only got one way in which you can get to the next stage in your life, and that's investing in property because you can use some equity in your home to pay off, to guarantee the deposit on that investment property. So that's the first thing. But the other thing is, so what if you have to top up that property? We help you. We look at borrowing buffers as well to take care of some of those top-ups, if not all of those top-ups, for the next 3 to 4 years. But even if you're topping up a property by $100 a week, it's a brand new property and you sell it in 5 years. So let's look at a $600,000 property. If it doubles in 10, it means that it's worth $900,000 potentially at year 5. So that's $300,000 in profit. So if you've got a $500,000 mortgage and you sell your investment property at year 5 that you bought brand new, that's potentially $300,000 of your home mortgage paid off. It frees up, day-to-day cash flow, but it also saves you on the interest that you're paying to the banks. So it's worth paying that $100 a week, say $5,200 a year for 5 years, because the saving is going to be over the next 15 years or 12 years. Now, if you had money in the bank, you had cash in the bank, and we have people that come to Propellor that have won the lottery. They've got funds from selling businesses or other properties. The reason that they come along and look at other alternatives, and this is one of the reasons why I wanted to talk to you today as well, Austen, because we've had clients that have bought some of your product because of the sort of returns. So if you've got it in, if you've got $1 million in the bank at 2%, that's $20,000 that you're then taxed on. And of course, cash is not inflation proof. Now, you've got an investment property that for 5 years is ticking over. And if it's the right sort of property, it is not going to impact on your life. Then in 5 years' time, you've got that capital growth. So maybe at the moment, it's not about getting a return immediately from, and I'm talking about an apartment, a unit, a townhouse, or even house and land. You're not going to get an income. It's not going to be cash flow positive, especially as, remember, it's 100% borrowing that we're talking about. But you're certainly going to get that potential capital gain. And so even if you hold that for 10 years or even 12, our cash flows don't show property doubling for 12 years. So in 12 years' time, you sell that $600,000 property, you've got $600,000. And so there is your home mortgage that's gone, which could save you hundreds of thousands of dollars, not only in your mortgage, but those interest payments as well. Now, we've also got clients that want something that is a lot more secure for them. Now, no investment is 100% secure, but if there's an investment that gives you a return consistently every week without fail, that is something that is very attractive to certain parts of the market. The other thing is that we have clients that are older clients that have come out of a business. They may have $1 million, they may have 1.3 or whatever it is, and they want to see a return that's better than the banks and a return that is consistent. Now, that's where we can look at a product that I know that Austen is very good at producing. It's to do with social housing. Now, I know for some that it's a dirty word, but we need social housing. We need housing that is not only rented by the government, but by other Habitat for Humanity. There are other social housing entities that are looking for housing, and we get approached on a regular basis. And I feel incredibly passionate about doing something whereby we can make a difference in the country, as well as being able to take care of ourselves and our families and our futures. It's a very, it's a balanced, brilliant, symbiotic relationship. That's how I see it.
Makes sense.
It does, yeah. And so here are some of the really scary facts about the need for social housing. There are nearly 27,000 people on the social housing register at the moment. There is a need for, I think actually that's 5 people in Auckland out of 1,000 that need housing. Most of those are looking for one-bedroom housing, and that's about 48% or 13,000 people. So we have this need. We have these social, we have these entities that are looking to help house these people. And that's where we feel that we can get this great balance. So I've talked enough, and I just want to, I'm going to ask you, tell me about your format for social housing, Austen, because you do this very well, and you've done it for how many years now?
We've been, Clarke Group's been around for 10 years, and I started developing, and it was developing this model. It was actually the type of model we build. It's kind of like a upmarket boarding house, if you will. And, where we rent out, all the rooms have got their own sort of kitchenette, their own bathroom, but they're centered around a common kitchen and laundry and lounge.
So they're townhouses, which we like.
Well, they're essentially either townhouses or apartments.
Yes.
And they can come in either format. But the main concept is that you're renting out by room rather than by the whole complex. And these complexes, they can be used either for the private market. So we've traditionally built close to key infrastructure, hospitals, universities, or town centres close to transport. And then sort of from 2017, we were approached by the emergency housing division of Kaianga Ora, or Housing New Zealand at the time. And there was such a strong demand for social housing that was sort of unmet, that they approached us to buy our complexes for use as transitional housing. So, very proud. We've got Women's Refuge in some of our complexes, Emerge Aotearoa, Salvation Army. And then more recently, we've arranged a lease with some community housing providers for a couple of our complexes. So just by way of background for your listeners, there's various forms of different social housing out there. You've got emergency housing, and you've got community housing providers, and also transitional housing providers. And so it just depends on where people are on that spectrum. In terms of some of the facts that you've said, Nikki, there's 26 or 27,000 people waiting for social housing, but that's nearly 21,000 more than 5 years ago. So, this has become something that's grown more acute. Now, the average number of consecutive weeks stays in the motels used as emergency accommodation has decreased from 3 weeks in the quarter ending December 2017 to 21 weeks in the last quarter. So there is a really strong need, for the government to provide emergency housing.
And, well, that's pretty obvious. I mean, I know of people that own motels that are making millions.
Crazy.
Which is absolutely crazy. Now, that's the social side of it. Let's look at the commercial side of it.
All on the taxpayer dollar as well.
No, exactly. So let's look at the commercial side of that, because with the developments that you've got, each of these townhouses or houses, apartments or whatever, and they're all furnished. There's usually about 4 to 5
rooms per every title.
Right. So an investor can purchase one of these homes or one of these units or buildings or whatever. And the great thing is that the rent is absolutely guaranteed 52 weeks of the year.
100%. That's right. Zero vacancy, completely guaranteed. So in terms of a couple of complexes that were most recently built, one of them has 72 rooms in Henderson Valley, and the other's got 75 rooms, Chapel Road in Botany. And so the titles are for every 4 or 5 rooms, depending on each of the complexes, so 15 or 18 titles. And there's now, by way of background, there's about 22 community housing providers in Auckland, so like the Salvation Army, Emerge, or Kahui Te Kaha. And they're not-for-profits, so they don't carry anything on their balance sheets, but they're there to basically provide these services for those that are most in need.
Yeah.
And some of the community housing providers are also transitional housing providers. Transitional housing is when it's more of an acute need where you're getting people off the street for about 16 or 18 weeks, rehabilitating them, and then moving them on to other types of social housing.
Which is fantastic. And the thing is that if you're an investor and you purchase one of these 4 or 5 bedroom units, you've got the guaranteed rental, which is actually, when you look at it at 52 weeks per year, I think with one of our clients, she she had a lump sum of cash. She was looking where she was going to put that. So she bought one of these properties. I think it was 1.3, so no more than a house and land, if you like. But the net return was a lot higher.
That's right. So just to follow through, was the community housing provider, or transitional housing provider to be exact, leases the property, there's a tripartite agreement with the Ministry of Housing and Urban Development, and they actually guarantee all the funding, because obviously you've got tenants that are, not necessarily the best financial standing, but because the Ministry of Housing and Urban Development provides the funding mechanisms, that rent is guaranteed for the tenure of the lease. So for the client, what we're offering, the lease with the transitional housing provider and with HUD is for 6 years. But we are offering a lease over the top from Clarke Group. We've got our own property management company, about 500 properties under management, and that's for a 9-year term, just to give the end purchaser a little bit more security in the tenure of the lease, and also because we're extremely confident, looking at the numbers that we talked about, that there's no way that these transitional housing providers will not need our services at the end of the
Oh, of
6-year
course
lease.
not.
So I think they'll be there for the next 20 years.
And of course, we were talking something like, I think, a net return of about 67,000.
That's right. So
And
yeah,
that's guaranteed.
and with rental increases. So every year there's a 1.5% renting increase that we pass on to the purchaser, and it's a 5.1% net yield. So if you look at other residential investments, it's I don't know of another residential investment where you can get a net yield of 5.1%. So that's after all costs are taken into account, and the purchaser gets their income. They only have to pay the rates and the body court fees. But as I said, it's 5.1% after all of those payments are made. And the yield is sort of akin to a commercial type investment, but with the vacancy rate of residential and
Zero vacancy rate.
Zero vacancy rate. That's right. Yeah.
And when we look at the long-term gain as well, and I mean, this is one of the things that obviously we focus on, which is that potential capital gain.
Yes.
From your point of view as a developer in Auckland and in Hamilton, where do you see the cost going? Up by how much per annum just to build?
Yeah, well, look, in terms of capital gain, I think costs is we'll address that. Just coming back to capital gain, I mean, the value of these assets is generally it's an income-based valuation methodology, which means that it's like valuing a shop or a business. You take what the gross income is, deduct all the expenses, and then the valuer will apply a yield against that, and that's where the value is. So for us, the value is assessed at as a 5% net yield, and hence the value. So as the rental income increases over time, thereby the capital value will increase.
So in fact, with those particular properties, that because of their profile, that they will have that capital that capital growth, that capital gain, just because of how they are and how it's put together.
Over rental increases over time. It's basically it's going to be tethered to what rental income is going to be seen like over the course of the next 5 or 10 years.
Now, if we look further afield at other types of properties, so I know that you've got properties in around Auckland anyway, and they're townhouses. They're 2 bedrooms or whatever. So it's a more of a traditional form of investment. This is where I think we come back to what is going to drive prices up for buildings. So let's just look at one of those. So you've got some in Alfriston.
That's right.
And what were they to build and when you were looking at your figures a year ago to if you were to start building again next year, the same sort of thing?
That's a good question. So typically we've only built this type of typology previously. So the build to rent model. I always like to give quick plug for my dearly departed mother. She was the matriarch of the model and came up with, and I couldn't beat it. So that's why I followed in her footsteps. So we've built over 500 rooms of this typology, and there's no one investment class, I believe, that's better than each other. It just depends on your individual circumstances as a developer and as an investor, which I think this investment definitely suits a profile of people, and townhouses suit other people. We decided that we would build this latest crop of townhouses, which is 170 townhouses over 3 sites. They'll start construction in November. And we've just agreed with our builder to all the price in order to build these on a fixed price contract. So I'm currently right on the mark with where construction pricing is, and yeah, it's shocking the amount that it's increased since a couple of years ago when I built our Henderson Valley complex. The Henderson Valley complex is an apartment, 3 stories. There's a lot of fire rating, fire attenuation stuff. It's more complicated than townhouses, but the square meter rate of my townhouses compared to Henderson Valley, which should have been a more complex build, is skyrocketed.
Yeah.
Shocking.
So going forward, do you think as a developer, I know the answer to this because, of course, we're recommending property to our clients every day. And what is very interesting as well is that we're seeing more of our clients that are coming in and actually getting finance. So that's another reason why on the ground floor, we can see that there is still this demand and a growing demand. But one of the things that I get asked is, well, shall we leave it? Shall we wait? Shall we wait and see how it drops? And of course, what I talk about as well is those that are serious investors. It doesn't matter what the herd is doing. If you've taken a long-term view, you're going to get the results from that long-term view. It's those that hold back or find excuses to hold back. So to those people that are waiting still for the market to bottom out in whatever format, the investment is, what's your view on that? Because I'm certainly not seeing any deals, from developers.
Well, look, it's crystal ball gazing, and it's just my personal view. I'm certainly don't consider myself a guru, but I personally believe that the margins are such on current townhouse developments that either they'll go ahead as they are or they won't. There isn't further room for prices to drop because any funder needs to see a reasonable margin in place before they'd be prepared to lend money on any particular project. So we'll probably see less projects go ahead over the next couple of years, and the projects that do will be well capitalized by respected developers. But I can't see prices going backwards because there's just simply no margin in the projects for them to do so. It's either they'll go ahead at the rate or they won't go ahead. And as there's less projects, I guess there'll be more demand that starts to grow, and then prices will escalate again. And that's underpinned by the fact that there's so much inflation in we've seen that with food prices, commodity prices, material prices, and you getting material shipped overseas where commodity and oil prices have increased. It all adds into the cost of building.
That's right. And as I said, when we first started this webinar, that in the inflation in the 80s was at 20%, but we still had people buying houses. And there is always going to be a demand, but it's like anything, whether it's bread or it's cars, you have to take into consideration the fact that, especially for New Zealand, a lot of the building materials are coming in from overseas anyway. We don't have any control over that pricing. I'm sure you find that with steel. I mean, how has that gone in the last couple of years?
Well, look, I always contract all my construction to a builder. I think that I'm probably I'm aware that I'm not smart enough to run a building company as well as the experts. So I leave that to them, and I leave sales to other qualified people like yourselves, Nikki, and so I can focus on my core competence. In terms of access to material prices, I think there's been some concerns around access to GIB in the market. I think from what I understand, a lot of those concerns have now been abated, and I guess that comes back to maybe less projects are currently being delivered in the market.
And when you said, which is it's true across all industries actually, to have the experts, that if you can, and I used this analogy recently, and it got a few laughs. But it's so true. Just because you go to webinars or you go to learn about property investment, and you read some books, I mean, you could do the same for medicine. But it doesn't mean to say that you're going to be able to give yourself brain surgery, for instance. It is important that you do use the experts, because you don't know what you don't know. And especially when with the markets, we only specialise in off the plan. And so we feel reasonably confident that by the time a property is built in the next 12 to 18 months, just to replace that property and the cost of materials is going to mean that if you were to try and replicate that you are going to be paying more. We've got house and land developments that our clients love in Christchurch, for instance. Now, quite a number of clients purchased 18 months ago and waiting for the build to complete, but they bought them in the early 600s. And they're now, if they were to replace them, in the 900s. And so that is because of the cost of build and because of the cost of land. But it comes back to utilising the experts to take you through. And it's the minefields of the right sort of finance that you have, how to ensure that you don't compromise your day-to-day cash flow, looking at what is the best profile of property for you. So, yes, it's a minefield, but if you're talking about $600,000, $900,000, why wouldn't you go to those that know how to do it the most? Now, I knew the time would go really fast, and it has. So I covered one of the main headlines at the moment. It's very difficult in 3/4 of an hour to get right into the nitty-gritty. But we've left some time for some questions and answers as well. So if we've got any questions and answers, and I'm going to let Austen, I'm going to let you read them because, of course, my eyesight, I forgot my glasses.
No problem. So any comments on the market saying too many houses for rent now? I'm actually quite happy that this question's been asked, because it's interesting to note, or that I've observed, there's actually been a drop in demand for rental properties in New Zealand, and I've noticed that from our own property management company, and there's been some media commentary about that as well. I do believe that it's going to be is short-lived. I think one of the facts can be that we've got net migration that's been heading out, and also we've had the borders that have been closed, and I think it's a temporary blip. Another point though is that we've currently got in New Zealand 600,000 households are renting. So it's a substantial part of the market, and it's not going to change.
Well, it can't change. Not with. There's always going to be a part of New Zealand society that buying a house is not the right financial decision for them, or it's out of their it's just out of their reach, for instance. And I think that's going to get worse. And I agree with you. There has been, it's not so much a shortage that we've got an oversupply. I think it's because we've waited far too long to open the borders again. And what will happen, I believe, because I've got property management companies as well, is that we will start to see the rentals go up. That they will. I mean, we only quote 5% increase per year, which is only a few dollars per week. But I believe that next year we'll certainly see a larger leap with rentals as well. So I don't believe that we've got enough. And certainly when we look at our house and land properties that are coming up that are built in, say, Christchurch, for instance, we've got families, we've got groups of families waiting to get in. There just isn't enough. Now, this is to do with where you rent as well. It's the areas, and that's part of the research that's got to be done. Where is there a demand for rental? Where is there a demand for an on sale in the future? And this is one of the things that a property investment company has to do and has to understand before they can start recommending properties to their clients. Big thing, we allow 2 weeks a year where a property is empty. So a tenant gives 3 to 4 weeks notice. So we're saying it's 5 to 6 weeks to find a tenant. But there are areas of New Zealand that I won't recommend to my clients because I can't guarantee that they're going to get rental.
Yeah. And I also think that the government is actively trying to increase, the build-to-rent market here, which is obviously very successful in Europe and the UK and Australia. And they're, offering sort of tax incentives such as interest deductibility, so that we can actually bring more build-to-rent here, defining it as a specific asset class.
No, that's exactly right. Any more questions at all?
No, that's us.
Oh, well, that's wonderful. Thank you so much for your time this afternoon. I've enjoyed it. As I said, I will get better. But if you've got any more questions, please, info@propellerproperties.co.nz or call us free phone 0800 81 81 91. And we have senior consultants that can talk to you about your situation as well, what you're wanting to achieve from an investment property, and to talk to you about your exit strategy from investment. Remember, it's a business, and people forget that they've got to have an exit strategy. So once again, thank you so much for spending time with me today. Thank you, Austen.
Thank you for having me along.
Oh, no, it's been really enjoyable. And have a great rest of your week.